Very much welcome to GAC Presents How to Invest in Stock Market Part 1. So friends, up till now we learned the financial position of the company on the very day of its incorporation. That's the balance sheet of the company, and thereafter the company's performance for a year, which was the profit and loss account of the company for the year. Together, these are going to give us the next balance sheet of the company. For that, we need to calculate cash position of the company, which is also a method of calculating cash flow through direct method, which we would be discussing exclusively when we would be discussing cash flow statement. But now we are going to calculate how much cash the company is left with to calculate the next balance sheet of the company. Friends, profit and loss account is a statement of company's performance during a period of time. In our example, this period of time was 1 year. The performance of company during this period is going to decide the next financial position of the company, meaning thereby it is going to create the next balance sheet of the company. We will see how. During this period, friends, we saw the company earned a revenue of 10,000 rupees. It means company sold finished goods of 10,000 rupees. We have assumed that out of this sale of 10,000 rupees, company sold goods worth rupees 8,000 for cash and goods worth rupees 2,000 company sold on credit, which created an asset in the balance sheet of company as receivables worth 2,000 rupees, which we have recorded here. The 8,000 rupees company's cash position we will calculate with the help of these 8,000 rupees. At the beginning of operations, in the beginning of year, company had a cash of 2,000 rupees. Now we see where company have spent the cash money. We calculate our cash position by the end of year here. From 2,000 rupees, company start with a cash amount of 2,000 rupees. Thereafter, for costs of goods sold, do company pay anything? I don't think so. Company have already purchased its raw material here. Company had already raw material at the beginning of company. That's why company didn't pay anything. For this, company have already paid 3,000 rupees in cash and 2,000 rupees in terms of payables in the very beginning. So company hasn't paid any cash during the very year for this cost of goods sold. Company has paid selling general and administrative expenses and advertisement expenses, which we have deducted from this 2,000 rupees here and here. Company has also paid interest amount of 700 rupees on this debt. This too we have deducted. Company has also paid tax of 840 rupees, which we have deducted here. During this time, company has earned a cash revenue of 8,000 rupees, which we have added here. This gives us a cash position of company to be 7,960 rupees. But yet this position has to be calculated. Now see, in the equity part, company generated a profit of 1,960 rupees. Assume the shareholders decided that this amount, company is new and has got a lot of prospects, so the amount should go for further projects of the company. That's why it would be added back to the equity. So we have added this back to the equity. In the next balance sheet, it would be recorded as reserves and surpluses. Again, coming back to liability, we see debt. This debt of 7,000 rupees, we have already paid an interest amount on that. But this debt is not going to remain with the company for lifelong. This has to amortize. In this case, we have assumed that company wants to amortize this debt or has borrowed this debt from the bank for 10 years. For the sake of simplicity, we are trying to amortize this debt on a straight line method, the same what we did for our property, plant and equipment. So 10 part of this debt amortizes every year. So the very first year, the amortization amount comes to be 700, the principal amount. The interest part we have already paid. This we have already deducted in our cash position. This is the amortization principal amount of the debt to be paid. The next year, in the very next year in the balance sheet, we are going to record a debt of 6,300 rupees instead of 700 rupees, and the interest amount would be calculated on 630 rupees. Payables, we assume that company has recycled its payables and it has maintained the same very position in terms of payables. Okay, now we look at assets. We have already depreciated our asset by 1000 rupees. Now for the next balance sheet, we would record our property, plant and equipment for 9000 rupees. 10,000 rupees this year, deducted the depreciation amount from that of 1000. The next balance sheet amount for property, plant and equipment is going to be recorded at 9000 rupees. Inventory, this entire inventory of 5000 rupees we have already exhausted as cost of goods sold. For that we haven't even recognized a cash expense. So we assume that by the end of year, at the last day of year, the company's inventory position was 0 and the company bought fresh inventory of 2000 rupees more. Now we remain with cash. Still in this very amount, there are two components left of cash payment. This 700 rupees of amortization which we have deducted further here, and this payment of inventory for 2000 rupees, this we have deducted here. This gives us a cash position of the company 5260 rupees, which would be recorded as cash amount of the company in the next balance sheet. So we try to have a look at our next balance sheet. So friends, today we saw that how much cash the company was left with and what alterations 1 year of performance of the company did in its balance sheet. Together, these will decide that how the next year's balance sheet of the company is going to look like. In upcoming session, we are going to learn about that. So stay tuned with us to know about that. Also concluding today's session, I request to you that if you like today's session, do subscribe to our channel, like and share its videos. This keeps us motivated to keep creating such videos. Once again, thank you very much.